how to get it right with whole life insurance. I'm going to begin this video with a story. When I was early in my career, I was working at another office and a doctor came into that office to meet with the owner of the office and another individual. I was not involved in the meeting. He had read a book on cash value life insurance and he walks into the conference room, throws the book on the table and says, I want to put $100,000 per year into this product, into whole life insurance. Now, he was primarily interested in the cash value benefit and what he could do with that cash value over time. The thing is, the policy he was sold did not resonate with that book at all. So what he went through as far as the actual policy when he purchased it was not maximum cash value. He purchased that policy, had next to nothing in it. In fact, this is very similar to what he actually ended up with on my right, your left. $100,000 goes into the policy, and this is what he had right off the bat. Next to nothing in cash value. 10 years, 11 years down the road, he's finally breaking even, but it was actually a little bit longer than that in reality because the dividend rate was much higher back then than it is right now. So this is a common problem of how people are taken advantage of, to use that frame of words, when he is interested. So you're interested in maximum cash value. What you're purchasing is what you think you want, and then finding out after the fact, wait a minute, why does it look so much better? I looked at this example, and if this is what you bought, why does this look so much better? Which is the same out of pocket for me, $100,000 per year, but I've got 88% right off the bat, positive by years 3 and 4, and more long-term as well. And by the way, this is the same company, exact same product, same out-of-pocket, same health rating, same everything. The only difference is we have broken up where his money's going. We put less toward the insurance premium and more toward the cash value to beat those values up immediately. So in order to prevent any of these from occurring, why was I not shown this before? This naturally comes up, which I get. How much did that other agent make in commission? Was it an impact, or was me having cash value an impact of his commission being higher or lower? I want to know. Someone asked me that this morning. Actually, completely different case. He happened to be a doctor as well, but he asked that question, hey, why is it so different from the example you're telling me about compared to what this agent showed me? Is it the commission? Like, what is it, Steve? He wanted to know. And I'm not going to do anything to beat up the other agent. I don't like that from a business and sales perspective, but it did have a direct impact. There's no way to hide that. How do I get it right from the get-go? Because of these bullet points. So really, the key is what we looked at here. We've got policy design, the steps. Look for what? When I am looking for a properly designed policy or a policy that's truly maximized for cash value, what do I have to look for? If I'm the consumer, you can reach out to us anytime. We're always happy to walk you through it. That is how we drive our business. But in year one, 100,000 goes in, 88%. If I paid in $10,000, that would be about the same. It might be 87% and change. Very, very similar if we add a zero or take a zero off. Step one, 85 to 90% in cash value in the first year. Between years 3 and 4 is when I'm breaking even. Meaning by year 4, I have paid in a total of $400,000 in this example, and I have more than $400,000. It is properly designed. And then the last bullet point, if we want to go back to this, flexibility. It's not a bill. So that example that we just looked at there, we saw $100,000 per year going into the policy, but here's the beauty of it. This is the thing I love, and this will never get old to me. It never has, and I've been in business now, or licensed for about 10 years. Here's the beauty of it. When I pay money in, or when you pay money in, if you're paying in a total of $100,000, you can pay money toward the insurance premium or toward the PUA component. That PUA component is a means of accelerating your cash value, buys you more life insurance as well. We've got other content on that. But here's the thing. The premium is a bill. So when you saw that 10% figure on that spreadsheet, what that means is that his premium was, guess what? $10,000 per year. And he only paid into it for 10 years. That could be 5 years if he wanted to. Whereas the PUA component was 90, but it was flexible. So I'll let you know with my policies personally, I have them set up in a manner where I have a minimal premium that never feels like a burden, and then at my discretion, I can just throw money into the policy. If I have a good quarter, a good month, I can add it in, borrow from it, leverage it as a line of credit through a lender, a lot of options in that respect. So I hope that you found this video helpful and informative. If you have any questions, please reach out anytime. We'd love to connect with you, and we'll talk to you soon. Thanks so much. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.